Welcome, everybody. We're still waiting for a few people to come in, but given that we're already 4 minutes past the top of the hour, I figured we would get started. We have a lot of ground to cover today. Natural resources and commodities and energy markets are certainly top of everybody's mind, and there's been a huge amount of development in recent weeks. And so I'd like to leave as much time as possible to hear from Leigh and to be able to answer your questions. But first, I just wanted to go through a few housekeeping items. First and foremost, today's webinar will be recorded. All of the participants are on mute except for Leigh and myself. We will provide a replay and send the link to that replay around immediately after today's webinar. If you'd like to ask a question, you can do so in the Q&A panel of the Zoom app. And we've also received several, in fact, I would say a few dozen questions from participants in advance of this call. So apologies if we don't get to your questions, if we don't get to everything, but as we've done in the past, I will try my very best to answer everyone's question following this webinar offline, if we don't get a chance to answer it today. And without any further ado, I'd like to turn today's webinar and call over to Leigh Goehring, Managing Partner of Goehring Rozencwajg, to begin talking about the commodity markets as he sees them today and where we see things going for the rest of 2022.
Okay, very good, Adam, and thank you, and thanks to all for you out there tuning in. We have a truly global listening base out there today. I'm just amazed from where all the calls are coming from. It looks like they're coming from all 5 continents, from what I can see. For those that don't know who we are at Goehring Rozencwajg, we're a firm that was set up specifically to do research and investing in global commodity markets. Most of you know us because we put our research out in the public domain for all of you to read. When Adam first came to work for me all the way back in 2007, I told Adam that one of our goals is that we were going to try to get our research in print and our ideas out into the market literally 6 to 8 months before they become the headlines of business publications such as the Wall Street Journal and the Financial Times. We wanted to be way ahead of any big change that was going to take place in global commodity markets. And it's something that we don't always get right, and we admit that sometimes we're wrong, but it's something that we're always striving to do. And it's interesting. I'm going to talk about 3 things right off from the start where that goal has been successfully carried out. For example, last week we sent out a blog to all our subscriber base, reminding them of a big essay that we wrote on inflation back in April of 2019. If you remember back then, no one was interested in inflation. In fact, everyone was still clamoring for 30-year bonds for capital gains and things like that. But we wrote a very large and insightful essay stating that we believe that we had been given the ultimate signal that the proverbial fat lady had come out on stage and the bell had been rung. That is, Business Week Bloomberg, the magazine that wrote the very infamous 1979 Death of Equities cover, came out with a cover story basically that said proclaimed the death of inflation. And we said, if that's not proof that inflation is going to be one of the great problems of the 2020 decade, we don't know what is. And we refined that essay about a year later, saying that usually Business Week magazine covers they're often right, perceived to be right in the short term, and that it's usually about 3 years from the time that the cover appears to the time that the change really begins to happen. Well, here we are, 3 years almost to the day for the publication of that cover. And inflation is going to be a huge, huge problem starting now, we believe, for the rest of the decade. And we'll talk about this a little bit more as far as investments, because obviously resources, commodity related stocks, excellent, all these type of investments in the past, in the various cycles that we've been in before with inflation, in bull markets, have provided excellent returns. We believe that this time is going to be no different. The other great topic that we wrote on literally back in summer of 2020 was the coming oil crisis. In fact, we titled one of our big pieces "On the Verge of an Energy Crisis," which outlined all the issues which are basically gripping today's global markets. And that is something I'm going to discuss, because we're not going to talk about what we wrote about in the past. I'm going to talk about looking into the future, which is what we like to do. And finally, back in, let's see, it was January of 2021, we wrote a big essay called The Coming Global Agricultural Crisis. Now, if for those that have access to Bloomberg, you punch up the grain page or whatever, every other article is about global agricultural crisis, this global agricultural crisis, that it didn't really come out of nowhere. We wrote extensively about it, and now it's here. And I'll also talk about how that is going to play out in the next couple of years. But let's talk about oil. We're on the verge. The oil crisis that we talked about back in the summer of 2000 is here today. And how is it going to play out going forward? One of the things I want to impress upon people is that most people really don't understand how we got here today and what the underlying factors are that brought us to the point that we have $120 oil. Most people are talking about what's happened in Russia and things like that. I would say that is probably, it's actually brought forward what we believe was going to happen by about 6 months or so, but we believe that we were going in this direction anyway, that we're going to have a global oil crisis at some point in 2022. And the reasons for that are really interesting, because they're reasons that people aren't properly thinking about. And if you want proof of that, just look at the up and down Wall Street column in Barron's this previous Saturday. There was some gentleman talking about sell all your energy stocks. This is the top. Supply is going to surge, things like that. The standard consensus lines. And I would say that that's a person that I don't think has really studied the energy markets that well. The two things that are driving the energy crisis today, and neither one is going to go away. One is the incredible strength of underlying global oil demand. This is something that we have been writing extensively about over the last decade. And what's causing it? It's just that there's just a huge amount of people in various emerging market countries that are now going through their intense period of energy consumption. And what's interesting about that is that we've had another huge addition to this group of consumers that are now in this period of high energy consumption, and no one's talking about it. Everyone's talking about China. They're still in the middle of it. They're still good. Their energy consumption for the next 5 to 7 years is going to be much stronger than expected. But it's India. India is now beginning to adopt all the characteristics of a country that has begun to enter that period of high energy consumption. For example, if you look at this 2021 estimates of global oil demand, I believe that India is going to show up as the number one year-over-year line item as far as oil demand. India's oil demand in 2021 could be up almost 500,000 barrels a day. That's a very large figure, and it's the type of evidence that we should be seeing from India if indeed they are entering this period of high energy consumption, which we believe they are. So that's 1.3 billion people. We have 4 billion people in the world today that are in that period of high energy consumption. So if we think that energy consumption is going to drop off going forward, at least the first 5 years of this decade, it just isn't going to happen. The second big problem in most analysis that takes place in the energy market regards supply. Now, one of the things that's interesting about supply is that people are beginning to recognize that for a variety of reasons, including ESG, we have woefully underinvested in the global upstream oil and energy businesses over the last decade. However, there's another factor there that's very, very important, which I don't think is getting a lot of press, which is, like I said, it's critical. Does anyone want to know what has produced 90% of the growth in global oil supply over the last decade, the last 12 years, so to speak? 90% of it has come from the US shales. In fact, everything outside of the US shales is actually decreased. Non-OPEC, non-US supply is decreased by about 150,000 to 200,000 barrels per day, per year over the last 10 years. And what's so interesting about the shales is that we study the shales intensely. Adam's going to come on in a minute and talk about the shales, that we believe that the growth that we got from the shales that started basically in 2010 is over. No matter how much money and how much capital and how much drilling activity we throw at the shales, that we're not going to see any net growth come from the shales as we progress through that decade. So with that, it's critically important, because once you're outside the US shales, remember, there's no growth in the world whatsoever. So here we are, 2022. We have Russia's invaded Ukraine. We're entering a period, or continuing a period, of incredibly strong oil and energy growth, which is not going to dissipate, no matter how much we would like it to dissipate going forward. And we have a big, huge supply problem. So Adam, why don't you talk about the shale, since they're so critical about understanding what is happening in global oil supply as we progress through this decade?
Absolutely. Thanks, Leigh, for that. And one thing I would point out is, when I first started working for Leigh in 2007, like he alluded to, he said, we want to be a year ahead of reading these things in the Wall Street Journal. And I thought to myself, what a daunting task that is, and how impossible, and what have I gotten myself into? But with a lot of hard work, and I think a lot of original thinking, it definitely is possible. And a lot of what we're going to talk about today are trends that we've been talking about now for 2 and 3 years, and are finally starting to be widely understood. But it's just beginning. And at the same time, like we said, there's so many parts of this energy market that are really misunderstood. And to give you a great example of that, before I talk about the shales, it was just a few days ago, a very prominent growth investor of the last couple of years, who believed that oil was going to $12 a barrel, came out and she tweeted that perhaps her forecast had been wrong, but that she didn't anticipate this acute supply disruptions we're seeing in the Ukraine now, and that her views on demand, which were basically that EVs were going to erode demand, were more or less correct. And I read that and I thought to myself, well, that's as far from reality as can be, because reading between the lines, what she was trying to say was, I'm sorry that I wasn't able to predict a war. Nobody can predict a war. But that's not true at all. This market has been tightening and tightening for several years now. It's been because we've woefully underinvested. The market has been screaming for more crude oil now for the better part of the last 18 months. Every metric that you look at, whether it's price, whether it's inventory, backwardation, all the classic market signals are asking for more investment. And yet we have not provided that, mostly because of ESG concerns. So far from being a unexpected, out of left field geopolitical shock, the writing was on the wall here. This market has been tightening for some time, and the implications are going to be with us for a long time to come. Leigh was talking before about the powers of the U.S. shales, and in fact, the ramp up of the shales from about 2010 to 2020 were really nothing short of extraordinary. It was a larger reserve development than any other time in human history. It's basically on par with the Saudi mega fields brought online in the 1950s and 1960s. And so what you had was an unbelievable new source of supply. And it was a little bit different. It wasn't conventional reservoir rock. Instead, it was source rock. It was tighter. It needed fracture stimulation, and it was much more aerially extensive. And it seemed as though it would go on forever. And that was really the message that the industry put out. We have this new resource. Remember, in 2010, everyone felt that we were running out of oil. Hubbard's Peak was extremely popular as far as a theory goes, which, mind you, I think was probably true. And there was now this feeling that all of a sudden we've opened up these new reserves and these new basins where there'd be no dry holes. Everything you drilled would be productive. And that's true, but it really missed a huge point, which is to say this is a finite resource like anything else, and it's going to ramp up, and then it's all of a sudden going to begin to plateau and decline. And we became fascinated with trying to measure what those declines would ultimately be, and where the shales would begin to ramp up and then eventually stop growing. And what we did, as our followers will surely know, we actually built a very sophisticated computer model and neural network to try and better understand where the sources of productivity growth, because each individual shale well was getting better and better and better all the way up to 2016, 2017, and 2018. Every year was better than the last. And we wanted to figure out why. And the reason it was so important to figure out why was that if the shales were getting better because we were getting better at drilling them, then we effectively were turning very poor second tier shale acreage into perfect tier one high quality inventory. And that meant that we would be able to produce for decades to come. Instead, what we found was exactly the opposite. We weren't getting much better at drilling each individual well. Instead, we were getting better at finding the best parts of the basin and focusing all the time and attention on there. We were high grading. Now that's really different, because what that means is that there's not an infinite amount of inventory. And in fact, it means that we are favoring and going after those tier 1 acres preferentially, and we're going to run out of them. And so we started to make some models, and we said to ourselves that based on the current drilling activity rates and things of that nature, we weren't going to see any new productivity enhancements out of any of the 3 shale basins, and production itself in the Bakken and the Eagle Ford would begin to roll over, and the Permian would still have a little bit of growth, but nothing like it had seen before. And in retrospect, I think we were proven correct. The idea of tier 1 inventory depletion is now very widely discussed across the industry. We've not seen the supply responses in the Bakken and in the Eagle Ford. Those productions are still massively disappointing. We just saw a large merger of equals between Oasis and Whiting last week. So on the M&A front, we're seeing things that are sort of suggesting that there's not this huge inventory of tier 1 locations out in front. A merger of equals in the Williston Basin is not the stuff of major development. This is really sort of a merger of necessity to help grow scale and help to try to keep costs down wherever possible. The Permian is growing a little bit. However, it's not growing nearly what it was doing before. And what growth we are seeing, we think is about to slow down and eventually stop. And why do we say that? Well, if we got something wrong last year, and every time you try to look into the future, you're definitely going to get things wrong. And we don't try to hide that. We're happy to admit what we got wrong. Sometimes it's greater, sometimes it's smaller. But what we got wrong last year was we didn't appreciate the so-called duck liquidation. So going back into the COVID period, all the energy companies, to try to save money, they neglected, or they deferred the completion of their drilled wells. So they built up what are known as drilled but uncompleted wells. Half the capital cost of a shale well comes in drilling it, and the other half comes in completing it. So most of these energy companies, to try to save money and to try to avoid increasing production, decided to defer the completion of their wells. That created this huge backlog of drilled but uncompleted wells, and those were drawn down quite sharply in 2021. So that resulted in a big surge of new production, sort of a one-time surge in new production, if you will. And we didn't fully appreciate what that could actually do. So we did get a sort of gasp of production growth out of the Permian last year, but we don't think that's going to continue. And in fact, the latest data that we're seeing suggests that we're right. Duck inventories have now largely normalized. In order to grow production more in 2022, we're going to need to put more rigs to work. And yes, the rig count is up a little bit, but it's nowhere near where it needs to be. And when you look at drilling permits, which tend to have a sort of 3-month lead time, we're not seeing any big increase in drill permits either, which begs the question, if you had gone back a year, 2 years ago, all the phone calls that we were fielding said, look, oil's $20, but as soon as it hits 40, we're going to see this massive increase in capital spending in the industry. Remember that? Well, 40 came and went, and 50 came and went, and 70 came and went, and we just didn't see that increase in activity. So where are we today? Well, the oil rig count bottomed at just under 200 rigs, 175 rigs at the very, very depths of COVID. Today, we're up at about 510. And that, just to put that number in perspective, in 2019, right before COVID, late 2018, right before COVID, or year before COVID, we topped out at 900 rigs. Going into COVID, we were down at about 700 rigs. And I should point out, right before COVID hit, with 700 rigs turning for oil in the United States, the shales showed zero growth. They showed 4 months of back-to-back zero growth. Then COVID happened, everything was shut in, and the data became very, very noisy. But I would argue that a 700 rig count is not enough to hold production flat, let alone grow. And here we are, we're at 510, 515 today. So where did things, you're 41% below where you were in 2019. You are a massive 67% below the 1,600 rig peak back in 2014. So, we're just not seeing the supply response. Yes, it's come up off the bottom, but we're nowhere near where we need to be. And that's so important because we don't have any other non-OPEC sources of growth. Like Leigh said, everything's been coming from the shales, and these just will not be this massive spigot to turn on the way everyone had relied on them in the past. So Leigh, did I miss anything?
No. In fact, look for U.S. oil production to actually begin to stagnate here, and then based upon our modeling, we should begin to roll over and begin to decline as we go through the rest of 2022 as the duct liquidation, which Adam just talked about, comes to an end. So putting all this together, what does this mean for 2022? Well, obviously it's tremendously clouded by all the problems going on in Ukraine and the Russian invasion and everything. But our modeling said, even before the whole Russian invasion started, is that we were going to have very, very strong demand in 2022. We disagreed with the IEA modeling as far as their 3.1 million barrel a day year-over-year increase in non-OPEC oil supply. And using our numbers, what we believe was going to happen by the fourth quarter of 2022 is that global oil demand was going to actually run very, very close to global oil pumping capability, which we estimate to be about 102 to 103 million barrels a day. I should point out that we have never, ever been in this situation before. Even going back to the 1970s, the two great oil crises in the 1970s, the 1973 Arab oil embargo and the 1979 Iranian crisis, where you had huge upward pressure on price. Global oil demand wasn't even close to total pumping capability. But by the fourth quarter of this year, we are going to get very, very close. We don't know what that world looks like. We have never, this is a first in the 160 years of oil market history. So, but what it does say is that oil markets are going to get tighter and tighter if that's possible through this year. Now, just to show you, we're always looking for data points to prove we're right. The supply is running greater demand. Right now, we have entered the global inventory building part of the oil inventory cycle. Oil inventories should have bottomed on a global basis in the first week of January. It should be showing significant growth now as we go into June and July. However, what's interesting is that oil inventories on a global basis, specifically here in the US, which have real-time data, are continuing to decrease. They are drawing counter-cyclically, which again points that global oil demand is severely outrunning supply. And like I said, this is happening before the Russian invasion in Ukraine. So we look for oil price markets. We don't know what's going to happen in the Ukraine and things like that, but we look for a continued tightening to happen. And if there's for example, if we wake up tomorrow and Putin says, I'm giving up, I'm moving out of Ukraine, and you have a big drop in oil prices, I would use that as what I would call the last great buying opportunity. So we don't think that this bull market in oil is anywhere near close, and it still has many stages left to go. Now, I'm going to make one more comment about about global natural gas and U.S. natural gas, because I think that's where we're going to see potentially the next crisis. As you know, this global energy crisis first made itself felt in European and Asian gas in the summer of last year, where prices really breached $25 per MCF for the first time. And what's interesting is that that was only the first leg. In fact, global international gas prices actually hit $50 per MCF in December of last year, which, mind you, is the equivalent of almost $300 per barrel oil in oil equivalent terms. So we have a full-blown gas crisis, and the reasons for that, we've written about it extensively, is that we completely underestimated the global demand for natural gas. We've modeled it, and we wrote a big, huge paper about this well over a year ago, saying the demand for global LNG and total gas demand was going to surge. And the reasons are very much the same. As the country gets richer, you want to change your fuel mix away from coal, which is a very, very dirty fuel with a lot of unpleasant externalities, to natural gas, which is a much cleaner fuel, but it's much more expensive to handle and burn because it's a gas and not a solid. But as you get richer, there's a predictable pathway where you begin to change your fuel mix. And we've modeled all that, and we know our estimates. We stated that total global demand for natural gas outside the United States was basically, even the most conservative estimates were almost 50% higher than what the world would ever be able to produce between now and 2025. So where did it show up first? In Europe. for a variety of reasons. And we'll talk about ESG in a second and how this is all playing into this, because I know a lot of people are very interested in our last paper on ESG and would like to hear our thoughts on that subject. But what's interesting about gas here in the States, we had a very warm November and December. U.S. gas inventories finished 2021 about 5% below normal. We've had a pretty normal winter so far, a little colder in January and February than normal, but we've drawn inventories down very strongly. We're now 17% below 5 and 10-year averages on gas, and we're probably going to go lower. So we have to watch very, very carefully. If we have a cold March and into April, which a lot of the weather models are now implying that we could see a lot of upward pressure on U.S. gas prices. And so look for that market to see a lot of stress potentially in the next 6 months. So finally, just to talk about global ag crisis again, this is something that is going to be hugely important because people have to eat, and global food prices are in the process of skyrocketing right now. And not only the grains, but things like the vegetable oils and palm oils and things like that. What are the things that's happening in global agricultural markets is there's one thing which is energy related, the other thing which is Ukrainian related, is that what are the great inputs to the huge productivities that we've seen in global agriculture over the last 20 years has been a increases in fertilizer application. There's no choice about it. But there's one problem with fertilizer, the making of fertilizers, it's incredibly energy intensive. I mean, nitrogen is basically turning energy into fertilizer. And there's a huge amount of energy that also goes into the making of phosphate fertilizers as well. Well, because of the high prices, we've seen curtailments in both nitrogen and phosphate fertilizer production in China and Russia, and now in various parts of Europe because of natural gas prices. Fertilizer prices have spiked hugely, and we're beginning to notice there's anecdotal stories of fertilizer shortages pertaining to the nitrogen complex that are beginning to form already. Now, one of the interesting things about fertilizers is that farmers can go a year or two, multiple years actually, with phosphate and potash applications, basically cutting them back and skipping them because those minerals are stored in the soil. Nitrogen is a completely different story. It is basically evaporates out of the soil and has to be reapplied every year. And sometimes in the United States, we apply it almost twice a year to get the best productivity increases from it. So if we begin to skimp on nitrogen fertilizer applications in 2022, we're going to see a big potential impact on global grain yields coming into this harvest year, the 2022 year. So it's something to really watch about. And then second, remember Ukraine is it's often been called the world's breadbasket because of its huge amount of wheat production and corn production that takes place there. And given the war, there's a lot of talk that much of the harvest, much of the crop will be either significantly delayed in planting in 2022 or may not be planted at all. So again, it's going to be another big, huge supply response. So, we love the agricultural space. We recommended over and over again to our investors that you want to own the fertilizer stocks because they were one of the best ways to play it. They've been excellent stocks so far this year, last year and this year. We believe that this whole cycle is only starting going forward. So, those are the things to watch for, the big items to watch for in global resource markets as we get our progression through 2022. And with that, I'm going to turn it back to Adam, and we're going to start talking about ESG. We put out a big ESG paper in our first quarter letter, which came out, I think it was about 2 weeks ago, outlining the research that we've done on it. There's a lot of people that some agree with us. Some of us are, say we're not properly incorporating the boundaries in the whole ERO-OEI argument and things like that. But it's a critical issue, and we believe that the ramifications of what we've done over the last decade have already manifested themselves, And that's a topic for another day. But what I'm talking about is the energy crisis in Europe, where Europe has basically already invested $1 trillion in renewable energies with huge unfortunate consequences. So with that, I'm going to turn it back to Adam, and if the ESG argument is all yours.
Great. And Leigh, I'm going to ruin your day because you keep mentioning the first quarter letter. We haven't written the first quarter letter yet.
I'm sorry, I'm ahead of myself.
Lee said to me the other day, he said, in our next letter in June, I said, no, we have the March one to do too. So all the letters, one's bleeding into the next. Look, I think what's so interesting when you think really about what's happened over the past decade from an ESG perspective, and we made this case quite strongly, I think, in the fourth quarter letter, I think it represents the biggest malinvestment we've ever seen. We're talking about trillions of dollars that have been put into technologies that ultimately will fail at what they're trying to set out to accomplish. And not only that, we've had, as if that's not bad enough, we've had massive malinvestments in the past, but to have malinvestment in something as critical as energy, I think we're starting to see some of the potential ramifications to that and just how serious that is. This is not simply a question of wiping out the equity of the bad investment. This is not having invested in something as fundamental to our economy as the energy supply, and the security of the energy supply is going to have huge consequences going forward. But in a nutshell, if you look back over the last decade, clearly we've been consumed and concerned with trying to reduce carbon and CO2 emissions to try to avoid man-made global warming. And that has manifested itself in what I would call this cult of ESG, which is to say a series of rules for institutional investors to stay away from carbon emitting industries like the oil and gas industry. And for those of you who aren't active participants in the institutional investment business, this has been a huge issue in the last 10 years. You have massive pension funds, endowment funds, either divesting outright of their fossil fuel investments or having to adopt very, very strict protocols that prohibit them from owning any oil and gas stock or buying any new investment in the oil and gas business. And what that's resulted in is it's resulted in a huge, sharp decrease in capital flowing into the industry. If you look, as we've talked about before, at its peak, oil and gas was 30% of the S&P 500 in 1980. For most of the last 30, 40 years, except for the last few, it's averaged about 12 to 15% of the S&P 500. And it got as low as 1.8% of the S&P 500 in 2020. Even now, you're talking about 3.5% of the S&P. So still dramatically, 2 standard deviations below average. That's because even though we're having all these price signals, and even though we're having all of these market signals to attract capital back into the space, we're just not able to do it because of these limitations. And what that means, just think about it. The commodity business is a cyclical business, and the oil business is a cyclical business. Prices are high, companies can generate supernormal profits, capital's attracted in, the stock prices rise, and that brings on effectively too much new supply, and the cycle works in reverse. And now you're oversupplied and prices fall, capital is pushed out, no one wants anything to do with it, the market slowly tightens, and then it goes back into a new bull market cycle. And that's more or less where we are now. We've gone through a 10-year massive bear market. Capital, 90% of the capital has been pushed out of the space. No one is spending anything on new drilling and things of that nature. And the market has been tightening and ratcheting tighter and tighter and tighter. Now we've hit the point with strong demand, production shortfalls, and now geopolitical shocks where we're in a severe energy deficit. So prices have spiked. We're in massive backwardation, which means the future price of oil is lower than the current spot price, which is a sign of market tightness. And the market is begging for new supply, except we're not bringing it on. And that's because of ESG. So that means that this cycle is going to snap much farther to the upside than it would normally, which already is a very cyclical industry, with big bull markets and big bear markets. And the reason that this has all happened is because of the allure of wind and solar, effectively what have been put out to be carbon-free sources of power. The problem is they're very energy intensive. If you talk about how much energy you need to dispatch a usable unit of energy in the oil and gas business, it's a fraction of what it would be in the renewables. So for every unit of energy in, you get 30 units of workable energy out if you're talking about a hydrocarbon-based power system. If you then move to wind and solar, and you properly back it up because you need to have backup because of short-term fluctuations like clouds and wind patterns and things like that. And then you back that up with batteries because you need to be able to bridge between night and day. You're talking about for every 1 unit of energy in, instead of getting 30 units of energy out, you're getting between 3 and 5 at the most. And again, people might push back on that. I've heard people say it's as high as 14 units of energy out. That's if you're just looking at the windmill itself, right? So that's if you're just saying how much energy to build that one windmill versus how much energy comes out over its life. That is going to be higher, but that's not suitable for baseload power. So if we're going to go down this path and we're going to have a huge rollout of renewables, you need to really look at it on an apples to apples basis. It would be like not including, half the energy cost of the traditional hydrocarbon in your calculation. So when you really account for everything, you're substantially worse off. And what that means is it means that basically we have less surplus energy with which to run our economy, less surplus energy by which to grow. And right off the bat, it means that a huge amount of our productive capacity simply gets diverted from investing in the economy at large and goes towards simply producing more energy. And that is extremely detrimental to all of us here. Now, the big question that people ask as we've written some of these things is they said, well, how could we have made such a bad mistake? How could things have gone so far down this path? And what could possibly be the catalyst for people to realize that this is in fact happening? And we thought about it long and hard and tried to figure it out and tried to just really point to one thing other than mass delusion. And I think what we came away with was quite interesting. This is a very unusual decade, and it was unusual for two main reasons. The first is that it had the lowest cost of capital in human history. And the second is that the price of all forms of primary energy, oil, gas, coal, nuclear, renewables, fell by between 80 to 90% peak to trough, right? Oil went from 145 down to negative. Gas went from $15 an MCF down to 145. Uranium went from about $135, $140 a pound down to the teens. So every source of energy input fell by 90% peak to trough. We can't really find another decade that matches that. To have such a severe drawdown in energy prices and to have it occur in every commodity at the same time is fairly unprecedented, which I know is an overused word these days. What did that result in? Well, the decade in which capital was free and energy was abundant, basically free, we rolled out a massive $1 trillion capital spending project on a technology that was a huge energy hog. And I think that that's no coincidence. I think when we look back, people realize that cheap capital and free capital leads to a malinvestment of dollars, but they don't fully appreciate that cheap energy, which is what we've had, leads to a malinvestment and a misallocation of energy. And that's exactly what's happened over the last decade. And so we came away with the contention. We said, look, as soon as energy becomes near and dear, that's when people are going to begin to realize the limitations of wind and solar. But again, think about what I'm telling you. What I'm telling you is that the big downside, the big drawback of wind and solar is that they are huge energy consumers. Well, it stands to reason that that's not really so much of a problem when energy is cheap and abundant as it has been over the last decade. But that doesn't mean it's a good investment. That doesn't mean it's a good path forward. And I think a lot of those challenges are coming to the fore right now. We estimate that if you were to really push forward and try to run an economy on something with an EROEI similar to wind and solar, it would mean two things. First of all, it would mean basically between a 40 and 45% degradation in everyone's standard of living today. And it would allow for basically zero growth going forward. And why do we say that? And those sound like big, bold claims. Well, if you go back, the last time we had an energy return on energy invested of 5-1 was basically through all of human history up until we discovered how to use coal. So from effectively prehistory all the way to the 17th century, all of civilization used biomass in order to generate its power. That was the main form of the power system. We would grow crops, we would feed animals, feed humans, grow trees, use the trees for both heat and then very minimal smelting of metals and for shelter. And that type of an economy with an EROEI of 5-1, that resulted in basically no growth for 17 centuries. The whole population doubled in 1700 years. It's pretty shocking, 0.02%. CAGR, so since we discovered coal and that EROEI went from basically 5-1 up to 10 and then eventually to 30-1, that is what has ushered in the modern age. That's what's ushered in the 3% plus growth rates that we've enjoyed over the last 250 years. If we went back to wind and solar, we'd be going back to something with an EROEI of 5-1. 40% of our surplus energy would evaporate overnight. It would be redirected into just creating more energy, and we would be able to grow at 0.02% per year. And so I think people are beginning to realize some of those challenges and limitations, and hopefully that's really coming to the fore now. So we haven't had to test the model because we've had cheap, abundant energy, but that's quickly changing. And, as an analyst said, which I thought was quite clever, people are talking now about trying to do a huge rollout in 2022 of wind and solar to try to break free of Russian fossil fuels. But the problem is we don't have enough energy to build all those windmills and solar panels. If you think about it, these things require a huge energy investment up front, and then they pay like an energy dividend over the next several years, 10, 20 years, depending on the technology and the climate and the conditions. We don't have the energy to do a massive wind and solar rollout in such an acute energy crisis. So people think of these technologies in complete silos, one from the other, but they're not. This is all interconnected, and if we don't have the energy availability today, these projections of wind and solar rollouts are simply delusional.
It's interesting. I see there's a lot of questions coming across the bottom of our screens. How does nuclear fit into this? They want us to talk about nuclear. So, nuclear power is just the opposite of what Adam just described. That is, the investment in renewables, wind and solar, has a very, very low energy efficiency. The investment in nuclear power has just the opposite. It has an unbelievably high energy efficiency. And here's just a thought experiment for you. Say, for example, over the last 10 years, that Europe, instead of investing $1 trillion in wind and solar farms all over the place, what happens if they took that $1 trillion, invested in a nuclear plant buildup? What would happen? Power prices would be so low that everyone's saying, oh my God, we have to give the power away. And you know what would happen? We would not be producing any CO2 in Europe at all. And just the opposite has happened. We don't have the statistics yet, but when the BP statistical survey comes out this summer for the 2021 year, we'll find out that Europe's coal consumption made an all-time new high. So what Adam's just described is actually being applied in the real world, in the real world experiment today. And you can see the results are highly unsatisfactory. You're getting poor energy prices, like electricity prices in all over Europe, are now up 4 times what they were just a year and a half ago. And you're producing more CO2 than you've ever done. So you haven't solved anything. And we keep getting a lot of stuff like, oh, well, you're not incorporating the fact we're going to build bigger windmills. That's not going to solve the problem. Have you ever thought a windmill is twice as big, is going to cost twice as much energy to build? So the economies of scales that everyone is thinking about just aren't there. But that's one issue. So nuclear power is a huge solution. We're very, very bullish on uranium. It's a big, significant part of the funds in which we manage. We believe, that the underlying supply-demand fundamentals in the uranium markets means that we're going to see big deficits in uranium markets emerge in the next couple of years. Uranium prices have more than doubled off the bottom already, but we believe that they're going to go significantly higher. And there's been a big, huge sea change that's taken place in Europe. Adam, you want to talk about that, the whole taxonomy thing? This is really important, I think.
Sure. And then after that, we'll go into some questions and answers, because we've, as I knew we would, Leigh and I, when you guys aren't all here, Leigh and I just spend the day talking about this stuff to one another. And so we could talk about it all day here as well, but we should answer some questions too. What Leigh's referring to, of course, is the EU green energy taxonomy. So the Europeans decided to put forward a official taxonomy, or an official listing of technologies that quote unquote are part of the approved green energy transition framework. So clearly wind and solar were put in that category, but there were some borderline technologies, such as natural gas and uranium, were the two big controversial technologies, whether they should be considered as part of a clean energy transition strategy or not. And this is not academic, although it sounds a little bit academic. It's actually quite important, because there are trillions of dollars of money in investable assets in throughout Europe that need to adhere to various ESG mandates and things of that nature. And so this has a huge importance. In fact, the taxonomy was meant to prevent companies from greenwashing or saying that they were green investment funds when in fact they weren't. Now you could point to this rubric and say, how much do you have invested in these approved green technologies? Obviously, it doesn't leave a lot of flexibility going forward if things want to come off that list or not. So it's more rigid. However, it was one attempt to try to do this. So there's a huge amount of debate going throughout Europe. And basically, to really kind of simplify things, you had France and Belgium were very much in favor of including nuclear as part of the taxonomy. Germany and Austria and parts of Switzerland were not. It went back and forth right down to the 11th hour, but ultimately uranium and nuclear power was included, as was natural gas, in the EU green taxonomy. And that I think is really important, because if you think about it now, you have, and right on the heels of that, France announced new reactor builds, the first ones in Europe in quite some time, and permit extensions on some of their existing facilities. There's talk in Germany, which is clearly incredibly anti-nuclear following Fukushima, that they are considering a new reactor build as well, though nothing has been officially announced as of yet. What that means is that China, India, parts of the Middle East, and Europe now all view uranium and nuclear power as a big key pillar in their future of energy. Basically, only the United States is now lagging behind, which is quite ironic given the United States invented nuclear technology in the first place. I don't think that that'll last for long. I think the US will as well. And so this nuclear renaissance that people had talked about and people had hoped about, ourselves included, I think is now really on the verge of taking place here again. I should point out, when we made our uranium investments in 2018, they really weren't predicated on a massive new Western nuclear renaissance or anything like that. All it was based upon was the idea that we haven't spent any money on any new uranium mining capacity in over a decade. Some of the incumbent large flagship producers for Cameco and Kazatomprom were actually being mothballed because they weren't able to sell their material at their cash costs of operation. And China and India were going through a new build reactors. So you really didn't need this big renaissance, but now you have it. And I think the sentiment is changing. I think that's going to be incredibly important. So with that, we have a few minutes.
Well, Adam, let me chime in one more thing I want to talk to our listeners about, is that we were going to talk about inflation and how you protect yourself from it and how resources fit in. Obviously Adam and I are big inflationists, and we have always been believed that inflation is coming. And we just didn't talk about it. We wrote extensively about it. It is now here. Our belief is going to get a lot worse. And I did an interesting interview with Kitco, and I used I thought a very clever phrase. I said, we're going to look. We sit around the table in 2028, and we're going to look back on the decade that's 90% past, and we're saying, what was it all about? And I think it's going to be the decade of shortages. And we're seeing it right now. And the thing is that those shortages are all going to wind up in inflationary pressures, especially the fact that we just printed so much money over the last decade. So the idea is, if the inflation is a big problem, how are you going to protect yourself from it? Investments in commodities and commodity-related stocks, I believe, are going to not only protect you from inflation going forward, the inflation we see, it's going to be a big problem throughout this decade, but it's also going to give you a real return. And for that, I would like to use an example. There's been three big commodity markets over the last 120 years. One, ironically, was right in the middle of the Depression. I mean, no one talks about it, but it was driven by the fact that the US dollar was depreciated by 60% by the US government. So that's what caused a big, huge bull market in commodities. Commodities radically outperformed all financial assets during starting in the late 20s all the way into the early 40s. No one knows about that. The other one was back in started in the late 60s and ran all the way to 1980. I think that's the paradigm, the framework we want to look at. And the other one started in 1999, 2000, and ran all the way to 2011. During the 1970s, that commodity bull market was driven by inflationary forces. When it was all said and done, the inflation rate between 1969 and 1980 went up, say it went up 200%. And these numbers aren't quite right. I don't have them at the top of my head. But if you had bought a basket of commodity-related equities during that time period, say 25% oil and gas, 25% base metal, 25% precious metal, 25% agriculture, just simple like that, your return on that portfolio was double the rate of inflation. So not only did you protect yourself from the ravages of inflation of the 1970s, you actually profited from it. And we think that we're beginning to see that right now. There's going to be a lot of volatility in this space, but I believe that investments in commodities and related equities is going to produce good returns and above the inflation rate between now and the end of this decade. And I should point out, we talk to a lot of family offices. We talk to a lot of big institutional investors, a lot of endowments and things like that. And for most of them, do you know what their investment commitment to the space is? In fact, I would say almost all of them, zero. So what happens when all of a sudden, you go back to the 1970s when oil represented 33% by 1980 of the S&P 500? It represents 3.25% today. What happens when we have to do that? Well, we're talking about much higher equity prices in this area. And, it's there in front of you. The value is there, and there is no one invested in it, especially on the institutional side. So with that, Adam, I'm done for the day. Open up for questions.
Okay, excellent. Well, we'll probably go, for another 10 minutes here. Let's say we'll go a little bit over the hour mark, but like I said, there'll be a replay. So if anyone needs to drop off, please feel free to do so, and we'll send you the link to the replay. And afterwards, I'll answer some of these questions as well, and hopefully put that link to those Q&A as well. Well, Leigh, one area we didn't touch on that a lot of people have been asking about has been copper. So do you want to say a few words on the state of the copper markets today?
Yeah, one of the interesting things about copper, and again, we wrote back in 2016, 2017, all the factors that are driving copper demand today. In fact, most people didn't recognize it at the time. Copper was $2. It's basically, it's more than doubled and then some since then. Obviously the big demand drivers were China was still going to consume copper, and they're going to still consume copper. They cannot become a high middle income country without huge increases in their copper consumption. The ESG movement, generating power from renewables. Everyone we seem to still want to do it is tremendously copper intensive versus standard electricity generation from hydrocarbon based plants. And thirdly, it's going to be new copper demands coming from places like India, which is like I just mentioned with oil, is now entering that period of rapid commodity consumption, which will include rapid electricity consumption. So we have the demand factors in place. We have, again, we've underinvested in our global copper business. And we believe, we've written about this, the copper prices are going to go significantly higher this decade. So we like copper investments, and recommend investors, have significant copper exposure in their portfolios.
Okay, excellent. Let's see here. There's so many, and like I said, I apologize if we don't get to yours. Here's a really interesting one, Leigh. It says, you mentioned in one of your notes that we were deeply thinking about how we felt about coal stocks. Given the current views and the current situation in the energy markets today, how do we feel about this unloved space? And is there any opportunity there?
This is a question that's very, very interesting. If you go back and you look at every commodity bull market, I just mentioned the three of them, late 20s to 40, 1970s, and then the 2000s decade. What were the leaders of every one of those commodity bull markets? Coal stocks. Coal stocks were the leaders, and it looks like they're beginning to lead again. For those that want to invest in coal stocks, they had a big run here because seaborne thermal prices hit $450 a ton. Because of the dislocation that's gone to place on energy. Another facet of the energy crisis playing out in global coal markets. And coal stocks have done well. One of the interesting things, on a long-term fundamental basis, coal will be displaced by other things, either by nuclear or by natural gas, because coal does have a lot of externalities, very high CO2 production, pollution problems, things like that are associated with it. So we believe that the long-term fundamental view for coal is not as quite as good as natural gas and oil, but the stocks still are relatively cheap. So it's a conundrum for us. In the past, we've been huge coal investors. We've just decided to sit on the sidelines and watch from here.
Okay. Here's one that maybe I'll take. It says, do you have a view yet on the best emerging technologies for energy and energy storage and green transition? Or do you simply think the best option for future energy management involves nuclear? So I think, look, first and foremost, I do think that the best future for the energy transition, and even if CO2 weren't a problem, the best path forward is nuclear. We've been talking about how it has very strong energy efficiency. A few people have been asking in the chat window, its energy return on energy invested is 100 to 1, which is 3 times as good as the best hydrocarbons today, and is frankly off the charts. Every other form of energy that we've really been able to harness as a civilization over time has involved basically burning stuff and liberating energy through a chemical bond process. When you're dealing with liberating energy through nuclear, in this case, fission, you're really off the charts in terms of their ability to generate energy for the amount of energy put into the system. Now, costs have been quite expensive, and the reason for that has been largely, a huge focus on safety, which of course is natural. But with the idea that, as you start to produce more these what people are calling small modular reactors. Now, the small element of the modular reactor, frankly, is not of a huge amount of interest to me. But what is interesting is the fact that once you start producing these in a more repeatable manner, you will start to have economies of scale. And I think it's sort of funny because people in the energy transition are super keen to give wind and solar these huge economies of scale that sometimes they say, if we continue down this path, they'll basically be free. And you look at, from a thermodynamic equation, they're actually a physical impossibility how cheap they think they're going to get over time, following some kind of Moore's law, which has been shown not to hold for wind and solar. However, when in the case of nuclear power plants, I do think that there will be quite a lot of cost reductions as we get back into the business of building new reactors. There's obviously a huge learning curve in building these very high, complex, very, very safe, redundant facilities. So I think those costs will come down, but the energy return on energy invested, which is frankly what drives the true underlying economic process, is incredibly, incredibly, incredibly good. In fact, it's the best we've ever seen. Having said that, will there be other things, other sources of technologies that move forward? We're intrigued with a few different ones. We're intrigued with some unconventional storage technologies. So we really don't like lithium-ion batteries. We do like some other battery technologies, and actually we made a private investment in a battery technology company last year called Ambry, which comes out of MIT, has a chief scientist who we followed for quite some time and we think is very, very, very good. The battery business is awfully difficult. It's really tough. And there's all kinds of setbacks and things like that, but they're doing a wonderful job with it, with a new potential grid level storage battery technology. Ultimately, frankly, that will be important for data centers. That will be important for nuclear plants, which you don't think about, but they do actually need a little bit of surge protection and things like that to help balance out some loads. So even if wind and solar don't end up being big sources of future energy growth, which we don't think they will, I think grid level storage from these types of innovative batteries do have some a future ahead of them. I also think there's some really interesting technologies in the steel side of things that could produce steel with far less CO2. However, there's a lot of technologies that are being promised that can do that, but it takes much more energy to produce a ton of steel using these new low carbon ways. We're not so interested in that. We're looking for things that have very good energy return on energy invested, that have better energetics than what they're replacing, and that could potentially lower CO2 at the same time. Fiendishly difficult, because if you think about it, we've really optimized for efficiency over the last several hundred years. We have not optimized for CO2 emissions. So now if we start to optimize for CO2 emissions, almost necessarily we're going to have impairments on the efficiency. So we're looking for those rare cases where we can get both. And if people are interested in that, I'd definitely welcome them to reach out to us directly and look at some of those investment opportunities. Lastly, Leigh, I don't know if you want to take this one, or I can weigh in as well. With prices for crude rallying substantially higher here, and with LNG prices and Indian gas prices notably this week reaching $100 an MCF on a tick, or which is the equivalent of $600 per barrel oil. We're starting to get a lot of questions about demand destruction. So how do you think about demand destruction, and will prices ultimately, fulfill the balancing mechanism here and stop demand and allow these markets to balance?
Prices, I think we should begin to look at the oil markets, the whole aspect of price demand destruction begin to take place when oil is a total percentage of GDP is about 5% of GDP, which ironically is has a relationship with the EROI of the economy, 1 to 10, things like that. That that's not going to happen until we get over $150 a barrel oil. So the thing is that we're going to need to ration oil by price multiple times during this decade if we're right about our supply, no growth in supply argument. So we're going to see demand destruction. However, it's going to be, you're not going to see a lot of demand destruction until you're over $150 a barrel. And I want to point out something else here. This is, you're beginning to see this, talk a bit about it right now, is that one of the greatest sources of demand for commodities this decade may come from a source that hasn't been a source now for almost over 40 some odd years, almost 50 years. And that's the demand source for the need to carry more inventory. In a time period where prices are going to go up and people are worried about the security supply, what do? You hold more inventory. And it's beneficial to do so. You get inventory profit. And that was such a big deal in the 1970s that we had to change over our accounting system to account for it. We had to go from a LIFO system to a LIFO system because so much profit was coming from inventory profit. And make profit from inventories, you buy more inventories. So, we haven't incorporated that at all into any of our demand models, is when inflationary psychology and this prices will be higher in the future they are today framework, what is that going to do to demand? And it's going to be a source of demand that is going to come out of nowhere that no one is talking about. But we could very well, we're beginning to start to see it. So
excellent. Well, here, just to give everyone some really round numbers here, as far as like Leigh was saying, 5% of oil prices representing 5% of world GDP. You figure 100 million barrels a day, $150 a barrel. That's 36.5 billion barrels a year, $5 trillion on a world economy of about 85 trillion, it's about 5%. So that's at $150 oil, and where we are today, we're not bumping up against that. So I think that we're getting closer, but we can sustain probably $130, $140 crude for a period of time, or if not indefinitely, without it having a huge detriment and ultimately pushing the world into recession. To put that into context, in 2008, when oil prices spiked to 145, they were well in excess of 5% of global GDP, and that's when you started to really see impairments on the world economy. So at this point, we're coming up at 10 minutes past the hour. We have quite a few questions. I think we have about, it looks like 90 questions on the Q&A, and probably about the same number having been sent to us previously. I'm sure there's a lot of redundancy there, but I'm going to go through those now, and hopefully I'll get everybody an answer to most of those, and we'll post that along with the recording of this webinar as well. So thank you all for listening in today to the Goehring and Rozencwajg March 2022 webinar. Our plan is to do these fairly regularly, so we look forward to seeing you here again in a few months' time. Leigh, anything you want to end with?
Nope. Here's something very funny. A lot of people ask me, "Is this commodity bull market over? And what are you guys going to do when it approaches near over?" And with the implication that they've missed it, and it's not going to last that long. This is going to be, I believe, a very, very long bull market. And here are two things to look out for signs that this commodity bull market is going to be over. And I think when these two things happen, this will be the top its bull market. But you can see that we're very, very far away from this. First is the price of gold and the Dow will cross. Oh, that sounds absolutely ridiculous now, does it? Except that they did cross back in January of 1980 at about $850. So that would be one sign that this bull market is going to be over. And second, I believe that we're going to see a corner of the silver market. Which will be another sign. And remember, that's not so outlandish. The Reddit crowd, the Robinhood crowd tried to, went through a cornering exercise back in January of 2021. They failed, but we're going to see another attempt to corner the silver market before this bull market is over. So this bull market has a long, long way to run.
Great. Well, thank you, everyone. Thank you for that, Leigh. And with that, I'd like to thank everyone for listening in, and we will talk to you all soon. Please don't hesitate to reach out, shoot us an email, visit our website, gorozen.com to learn more. And we're here to answer any questions you might have. So thank you all so much.